guys, and welcome back to my YouTube channel. Now please excuse the state of my hair. I'm trying the whole no heat carry on, so it's probably going to be a mess over the next few videos, but please bear with me on that. In today's video I want to go over interest only mortgages, and the reason for that is because interest only mortgages used to be very popular in the marketplace, but they aren't as much now, but I'll go into why shortly. Before we jump into the video, if you could hit this video with a like and also subscribe to my channel down below, it really helps my channel to grow and reach a wider audience, so thank you in advance. Alright, let's jump right in. So what is an interest-only mortgage? It's simply a loan where you only pay back the interest on a monthly basis, so there's no capital reductions to the loan throughout the term. And as there's no capital repayments throughout the mortgage term, the whole mortgage balance is actually paid off at the end of the mortgage term. So whether that's in 25 or 35 years, that's when you repay the full amount. So if you borrow £100,000 today, you'll still have £100,000 to pay back at the end of the 35 years. Now let me give you a bit of a background to interest-only mortgages, as I know that there's been quite a lot of scrutiny and criticism over interest-only mortgages in the marketplace recently. And the reason for that is because interest-only mortgages were actually given to people who did not have suitable repayment vehicles in place to actually guarantee that the mortgage would be repaid at the end of the term. So interest-only mortgages were actually really popular right up until 2014, when the FSA carried out a mortgage market review, which was then subsequently implemented by the FCA, who were the FSA's successor. Now what came out of the mortgage market review was that a lot of people were actually taking out interest-only mortgages simply to cut down the monthly expenditure, which, let me tell you now, is not the right reason for taking out an interest-only mortgage. So in effect what that meant is a lot of people were left in very difficult situations at the end of their mortgage term simply because they did not have the means to actually repay the mortgage, and a lot of the times that resulted in repossessions. So since then the MCOB rules have actually been strengthened significantly to hopefully avoid this happening again. So what that means is borrowers must now demonstrate exactly how they're going to repay the mortgage at the outset. So you need to have a suitable repayment vehicle in place before you actually take out the mortgage, and you need to be able to actually demonstrate that to the lender and have proof of that, but I'll go on to that in a second. As part of the rules as well, the lender is actually required to contact you at least once throughout your mortgage term to ensure that your repayment vehicle is on track to actually repay the mortgage, and if it isn't, they can obviously step in at that point and help you figure out other ways to repay the mortgage at the end of the term. So what are acceptable repayment vehicles? So I'd say that there's 4 core repayment vehicles that will be widely accepted by lenders. However, what you'll find is every single lender has different criteria that you need to meet, and they will differ based on what you're looking to do. So the most common ones are an existing endowment. So as I previously mentioned, endowments have had a really bad name for a number of years due to the mis-selling of them. Basically what ended up happening is people took out endowments, low cost plans, whereby they saved a certain amount of money every single month into this endowment policy, which was promising a high return, a little bit like a stocks and shares ISA, I suppose. However, what a lot of advisors did, which is very naughty, is they actually mis-sold them. So they told people they could pay in less than what they needed to pay in. So what people found at the end of it was that they did not have anywhere near enough as much as they needed to actually repay the mortgage. However, nowadays lenders will still accept an existing endowment policy, primarily because they're expecting the value of it to be quite large at this stage, especially if it was taken out quite a while ago. The second most common repayment vehicle is actually an existing stocks and shares ISA or a cash ISA. Now, when I say existing, you need to have had it for at least 12 months prior to applying for the mortgage. Obviously, the longer you've had it and the more that you've actually built up in it, the better. But ultimately, a lot of lenders are looking for at least a 12-month track record of you kind of consistently paying into this stocks and shares ISA, which you'll need to continue right throughout your mortgage term. Now, the third one is your pension. So if you weren't already aware, when you turn 55, you can actually access your private pension and take out 25% of it tax-free. And a lot of people do that to then repay their mortgages. Before you jump and do that, do speak to an experienced financial advisor, as they will be able to tell you what the best course of action is, as it may not be the right thing for you to do. And the last one that I want to touch upon is sale of property. So this can either be the actual home that you buy in, that you're taking the mortgage out on, or it could be like an investment property. So if you have a buy to let, or if you've got a commercial property, that can be taken into account as well. Bear in mind that if you use your actual main home, the one that you've got your mortgage on, the lender will normally limit the amount of money that you can borrow to 50% off the value of the home, whereas normally you're looking at about 75 to 80% that they would normally lend. So just something to bear in mind. Now, there are also other ways that are deemed acceptable by certain lenders. That's why speaking to an experienced mortgage advisor will help you, as they'll be able to tell you which lender accepts which repayment vehicles and whether the one that you've got in mind is actually suitable and would be accepted. So why should you get an interest-only mortgage? Now, this depends on your personal circumstances at the end of the day. However, to give you some specifics, interest-only mortgages generally provide greater flexibility, as you can actually choose how you repay the mortgage rather than relying on your capital reductions every month. So in effect, that does make your monthly repayments a lot lower. However, this doesn't take into account the fact that you then need to invest in a suitable repayment vehicle in order to be able to repay the mortgage at the end of the term. Also, if the repayment vehicle that you've chosen outperforms your expectations, you may be in a position to actually repay your mortgage earlier than you thought and possibly have money left over. So it does definitely offer greater flexibility, and initially I guess it does offer lower monthly repayments, but I wouldn't concentrate on that, as you do have to manage an investment separately. So what are the downsides to having an interest-only mortgage? So the main thing is the fact that your debt is not reducing on a monthly basis, unless of course you decide to make partial repayments throughout the term. So you are left with the full outstanding balance at the end of your mortgage term. And as the balance isn't reducing, the mortgage will actually cost you more in the long run, as you're consistently paying interest on the same amount. Whereas when you've got a repayment mortgage, as you make your repayments and the capital reduces, the amount of interest you actually end up repaying is getting lower on a monthly basis. So that's why if you do end up opting for an interest-only mortgage, it is vital that you do attempt to make partial repayments throughout the term. Interest-only mortgages are also seen as a lot more complicated, primarily because you do have to manage a separate repayment vehicle, which technically hasn't got anything to do with the mortgage. It's a completely separate aspect that you need to manage yourself, and 9 times out of 10 lenders will not get involved in that. They just want to know what it is, but they won't help you arrange it or anything like that, so you do need to do that for yourself. So alright, following all that, you've decided that actually, yeah, interest-only mortgages are the right choice for you. Now, what happens if at the end of your mortgage term, so let's say in 35 years time, you find yourself in a position where actually the stocks and shares ISA that you've ended up paying into in order to repay your mortgage has actually not produced the required returns. You've not been paying in anywhere near enough than you initially thought, and actually you are going to fall behind on the mortgage. There's still going to be some level of the balance outstanding. Now, there are options, there are ways of going about it. So the 5 things you can actually do if that is the case are, the first one is probably the most obvious one, and it's to switch to a repayment mortgage. Now, do not wait until the end of your mortgage term to do this. If you think halfway through your mortgage, actually the repayment vehicle that I've chosen is not going to repay my mortgage on time, at that point approach the lender, discuss that with them and ask them to actually turn your mortgage onto a repayment basis. Be careful with that, just because at that point your monthly repayments are most likely going to be sky high, just because they're going to be based on a shorter mortgage term. So make sure you can afford it, and obviously the lender will do affordability assessment, and from their point of view, on paper you may not be able to afford it, so make sure you are in a strong financial position before you do switch onto a repayment mortgage. Now, the second thing would be to extend your mortgage term. Once again, this will highly depend on what your lender allows. So if, for example, your initial mortgage term was 30 years, there are lenders out there that will lend for 40 years. So it may be a case of switching to a different lender at that point. But once again, speaking to an experienced mortgage advisor, they'll be able to assist you with that and let you know what your options are. The third option is to make partial repayments. As I've discussed earlier on in the video, making partial repayments throughout the term will help you significantly in bringing the loan balance down without having to commit to regular monthly capital repayments, as is the case with the repayment mortgage. Number 4 is to use your pension. So once again, I touched up on this fact before because a lot of people actually use the pension as a repayment vehicle. Now, if you haven't chosen that, that is still an option for you. When you turn 55, you may be able to pay the leftover balance through using your pension. And number 5 is to downsize. So if you find yourself in a position where none of the other things have worked, you may have to look at selling your property and downsizing in order to be able to repay the difference. And in normal circumstances, nobody wants to do that, so do use this as a last resort, and make sure that you do plan for the future when taking out an interest-only mortgage. So that is it for today's video, guys. I hope I've given you an insight of the interest-only mortgage market and what they actually are and how they work, because a lot of people don't actually know the ins and outs of an interest-only mortgage. If you have any further questions, do pop them in the comment section below and I'll be more than happy to answer them. And of course, if you have any specific mortgage related questions, do drop me an email and I'll put you in touch with an experienced mortgage advisor. If you could hit this video with a like and also subscribe to my channel down below, it hugely supports my channel and allows it to grow. So thank you for watching, and I'll see you guys back on Friday with a brand new video. Bye guys!